Chapter 8: Interest, Credit, and Fictitious Capital. Section 1: Interest-bearing capital, interest, and profit of enterprise. The consummation of the capital fetish. For as long as money has existed, it has probably been lent at interest. Interest-bearing capital existed long before the entire economy was organized on a capitalist basis, and we find it in the most diverse social formations, in the slave-holding societies of antiquity, as well as the feudal societies of the Middle Ages. In pre-bourgeois societies, kings and princes incurred debt as a means of financing their luxury consumption and wars. Outstanding debts and interest were then paid back with money raised through taxes and conquest. But peasants and artisans experiencing financial hardship would go into debt. They had to pay back the debt by working, which in light of their penury and interest rates of 20 or 30% or more was often not possible. As a result, they lost their homes and farmlands. Expropriation by usurers was a widespread phenomenon. Lenders were perceived as, quote, bloodsuckers, and hatred for usurers was the consequence. Under the capitalist relations of production, that is, when production is also organized capitalistically, lending money occurs under completely different conditions. On the basis of capitalist production, a sum of money can be transformed into capital, and one can expect that this capital will yield an average profit. Money is not, as it were, under simple circulation, an independent expression of value, and therefore exchangeable with every other commodity. Money is now potential capital. Quote, in this capacity of potential capital, as a means to the production of profit, money becomes a commodity, but a commodity of a special kind, or it comes to the same thing. Capital becomes a commodity. End quote. Capital Volume 3, page 459 to 60. The sale of this unique commodity has a unique form. Money is lent. What is sold is money's ability under capitalist conditions to yield a profit within a specific period of time. The price paid for the unique commodity is interest. This interest is paid from the profit that was made with the help of the money. Non-capitalists, such as wage laborers, also borrow money, whether as a result of financial difficulties or in order to finance consumption. These loans must then be paid back out of wages. Such, quote, consumer credit are quite meaningful and also play an important role in the course of the accumulation process, since they contribute to the stabilization of demand. What is new in capitalism is that a large number of loans serve the enrichment of the debtors. They borrow money to use that money as capital. This form of credit, which only existed as an exception in pre-bourgeois societies, is the typical form of credit for capitalist enterprises and dominates all other forms. The special form of circulation of modern interest-bearing capital is therefore, and there's a diagram, money loaned to an industrial capitalist who uses that money to purchase commodities, means of production, and labor power to create a commodity that with an augmented value, and part of this money that's earned from the sale of the augmented valued commodities is distributed not only to the capitalist, to the industrial capitalist, but also to the money capitalist. But if you want an easier summary of what it says in symbols, it just says money, money, commodity, money prime, money double prime. Modern interest-bearing capital, and in the following we refer only to this type, and will therefore leave out the adjective modern, is thus advanced twice. Once by its owner to the industrial capitalist, and then by the industrial capitalist to finance a profit-yielding production process. There follows a double return, first to the industrial capitalist, and then from the industrial capitalist to the lender. The return to the industrial capitalist contains a profit, in the case of successful valorization, and the return to the lender contains interest, which is paid from this profit. The fact that interest is paid out of profit does not yet say anything about the rate of interest. Under, quote, normal capitalist conditions, the rate of interest will lie above zero, otherwise the lender of money would have no reason to lend it. But under the average rate of profit, otherwise the industrial capitalist would not demand additional capital. But under the average rate of profit. The rate of interest at any given time will depend upon the levels of supply and demand. A, quote, natural interest rate or a, quote, natural relationship between the rate of interest and the average rate of profit does not exist. Marx refers to the capitalist who owns interest-bearing capital as the money capitalist, whereas the capitalist who borrows his capital is the functioning capitalist, in whose hands the interest-bearing capital becomes functioning capital within the production process. Each functioning capitalist yields a certain profit, the gross profit, the amount of which can be above or below that of the average profit. Interest is paid from this gross profit, and what remains is the profit of enterprise received by the functioning capitalist. The division of gross profit into interest and profit of enterprise is initially just a quantitative division. However, this quantitative division consolidates into a qualitative division that even capitalists who don't borrow capital include in their deliberations. The money capitalist is the owner of interest-bearing capital. The money capitalist receives interest for putting his property at the disposal of others. Thus, interest appears to be merely the fruit of the ownership of capital that seems to exist outside of the production process. In contrast, profit of enterprise seems to be the result of capital functioning in the production process. Interest and profit of enterprise, therefore, appear to be qualitatively different amounts, originating from different sources. This illusion is strengthened by the fact that the rate of interest develops on the market as a uniform quantity does not depend upon individual capitalists, whereas the rate of profit of an individual capital, and therefore also that of the respective profit of enterprise as a surplus above the rate of interest, can definitely be affected by measures taken by functioning capitalists, reducing costs of the means of production, shortening turnover time, etc. The distinction between interest and entrepreneurial profit is also relevant for the capitalist who does not use borrowed capital. The capitalist who does not use borrowed capital has the choice of lending his capital and therefore obtaining merely the interest, or allowing his capital to function in the production process. However, the result of this functioning appears, for all intents and purposes, as profit of enterprise and not as the total profit, since he would have obtained the interest anyway. The capitalist class as a whole is not able to choose the manner in which it uses its capital. Without functioning capitalists, no interest at all could be paid. But the individual capitalist definitely has the choice. Interest is an expression of the valorization of capital, the exploitation of labor power. But capital stands in antagonism to wage labor only within the exploitation process. In the case of interest-bearing capital, this antagonism is no longer visible because capital is interest-bearing as property outside of the production process. The money capitalist does not confront the wage laborer, but confronts the functioning capitalist who borrows capital. Interest expresses capital's capacity for appropriating the product of external labor, but it expresses this capacity as a characteristic of capital that adheres to capital outside of the production process and independent of the determinate capitalist form of production. But the functioning capitalist who seems not to stand in an antagonistic relationship to the wage laborer. The profit of enterprise gained by the functioning capitalist appears to be independent of capital property. This is already paid through interest and is regarded as the result of functioning within the production process. A production process that seems not to exhibit any capitalist determinations, but appears as a mere labor process. According to this perception, the functioning capitalist obtains the profit of enterprise not as an owner, but rather as a particular type of worker, a worker responsible for the supervision and administration of the labor process. The work of exploitation and exploited labor both count as labor. As a result, quote, the social form of capital devolves on interest, but expressed in a neutral and indifferent form, the economic function of capital devolves on profit of enterprise, but with the specifically capitalist character of this function removed. End quote. Capital, Volume 3, page 506. What is peculiar to interest-bearing capital is not interest. Interest is merely a particular expression of the valorization of capital. But the seemingly unmediated form of this valorization, as expressed in the equation money prime. Money appears to multiply all by itself. Marx therefore refers to the interest-bearing capital as, quote, the most superficial and fetishized form, end quote, of the relations of capital. For how the capital fetish emerges from the capitalist process of production, see Section 3, Chapter 5. Because, quote, the social relation is consummated in the relation of a thing, money, to itself. Thus it becomes as completely the property of money to create value, to yield interest, as it is the property of pear trees to bear pears. End quote. Capital, Volume 3, page 516. Accompanying this, quote, most fetish-like form of the capital relation historically is a series of truncated critiques of capitalism that all amount to criticizing not the capital relation itself, but merely the existence of interest, thus disregarding the connection between interest and capital relation. The connection. The collection of interest was, on the one hand, contrasted to productive capital, and criticized on moral grounds as a form of income that is not based on one's own effort. On the other hand, the existence of interest was declared to be the root of all evil in society. All of society is enslaved in order to ultimately pay interest to the owners of money. Section 2. Credit money, banks, and fictitious capital. In the previous section, we examined the form determination exhibited by interest-bearing capital as distinct from industrial capital, as well as the inverted perception arising from it. Inverted perceptions arising from it. Now we must concern ourselves with the historically changing institutions that mediate the movement of interest-bearing capital, the banks and capital markets. Banks are brokers of credit transactions. On the one hand, banks receive deposits from owners of money, and on the other, banks lend money. The deposit rate of interest paid by banks is smaller than the interest rate charged by banks when they make loans. The bank's income comes from the difference. Whatever remains after deducting the cost is the banking profit. Our banks, Jesus Christ. But banks are not just passive intermediaries that transport money from one hand to another. Banks also create money, credit money. Credit money is a promise to pay that itself performs a function of money. Functions of money. Credit money already comes into being when person A borrows 100 euros from person B and signs a promissory note, not note that remains with B. If the note has a fixed, relatively short-term date of payment, one speaks of a bill of exchange. This promissory note is a promise to pay from A. If B now purchases a commodity from person C, and C accepts this promissory note as a means of payment, then A's promise to pay has functioned as money. Alongside the original 100 euros in cash, the real money with which A can make purchases, an additional 100 euros of credit money with which B makes a purchase is also in circulation. This credit money emerges, quote, from nothing, with the granting of a loan, and vanishes again into nothing with the redemption of the promise to pay. The promissory note is wiped out. As a rule, it is not only promises to pay by private individuals that are circulated, but also those of banks or institutions similar to banks, like credit card companies. If I pay for a purchase with a check or credit card, then the seller does not receive actual money from me, but rather a promise to pay, namely the formal guarantee that he or she will receive money from the bank or credit card issuer upon presentation of the check or sales draft, respectively. However, I am not the one who guarantees this promise, the bank does. Credit money results from every deposit at a bank. If I deposit 100 euros cash into my bank account, then the bank has 100 euros in its reserves and can lend this 100 euros, for example, to make a loan. At the same time, my account balance, which I may dispose of via check or bank transfer, increases by 100 euros. Thus, in addition to the 100 euros that was moved from my pocket into the bank's reserves, 100 euros of credit money have accrued to my bank account. Now, if the seller that I have paid by check uses the check to credit his account, the credit money was merely transferred from my account to his account and can continue to function as credit money. Only if the seller cashes the check, that is to say, requests cash from the bank's reserves, is credit money eliminated. In actual fact, the bank, barring legal regulations, only has to keep on hand a small fraction of the 100 euros I deposited in the form of cash reserves, enough to satisfy average demand, and the rest can be used. But since most payments are cashless payments between bank accounts, and since most loans are not made in cash but as credit money, the amount of money the bank has to keep on hand is a small fraction of the credit money it creates. In order to make loans, banks are not solely dependent upon deposits. Banks can also borrow money from state central banks. The central banks are the only institutions allowed to print money. In an economy no longer tied to a money commodity, central banks create real money, real as opposed to credit money, which is only a promise to pay money. The central bank is not bound by any formal limits concerning this money creation. As long as the money system was still tied to a money commodity, for example, gold, banknotes were not real money. Only stand-ins and issuing of treasury notes by central banks was still restricted by regulations. The issuing of money had to be covered to a certain amount by the gold reserves of the central bank. If a demand was made to convert notes into gold, gold reserves decreased, and the central bank could only issue a small number of notes. Precisely in crisis situations, there was a run on gold at the same time the need for credit grew, so that the banks required more banknotes. The run on gold made an increase in the issue of banknotes impossible without suspending regulations. The money commodity proved to be an avoidable impediment to capitalist reproduction. Since the monetary system today is no longer tied to a money commodity, this impediment no longer exists. Without a money commodity, the banking system can react more flexibly than before during crisis. However, this does not mean that crises themselves can be avoided. Contrary to the position of Marx that the existence of a money commodity is unavoidable in capitalism, it is clear that a monetary system tied to a money commodity is in no way a property of capitalism at its ideal average. On the capital market, borrowers and lenders of money enter in direct credit relationship with one another. Borrowers, above all large enterprises and states, get money directly from money owners and promise in return to pay a fixed annual interest as well as the principal at a fixed date. In return for making the loan, lenders receive a security or bond, in which conditions are stipulated. Because of the fixed interest rate, one speaks of a fixed interest security. Since the loan comes off without the aid of any bank, lenders and borrowers can share among themselves the difference between the rate of interest on bank deposits and the interest rate for loans offered by the bank. The interest rate on securities is normally lower than the interest rate of loans offered by banks and higher than the rate of interest on bank deposits. However, the lender now shoulders the burden of risk entirely. If the enterprise to which he has lent money goes bankrupt, he loses his money. For that reason, usually only large enterprises assumed to remain solvent are in a position to issue bonds. On the other hand, if an enterprise or individual borrowing from a bank goes bankrupt, this reduces the bank's profits, but does not affect deposits as long as the bank itself does not go bankrupt. Securities are not the only means through which business can obtain money on the capital markets. They can also do so by issuing stocks. Through the purchase of a stock, one acquires a share of their respective enterprise, becoming a co-owner. Similar to fixed interest securities, the stock constitutes a claim. The owner of the stock is entitled to vote at shareholders' meetings and to a slice of the distributed earnings called dividends, both proportional to the individual's percentage of the entirety of shares. However, there is no entitlement to the repayment of the price of the stock by the enterprise, and the level of distributed gains is also not fixed, but depends upon the course of business. Fixed interest securities and stocks can be sold on the capital market. Fixed interest securities and stocks have a price. Their respective market price or share price one can read the previous day's stock exchange quotations in the business pages of major newspaper. However, these papers have no value but constitute mere claims on value, interest and dividends. What are traded are claims. After the sale, the enterprise no longer pays interest or dividends to person A, but to person B. In everyday life, as well as in the dominant economic theories, no distinction is made between price and value. The market price of the stock or fixed interest security counts as its value. The amount the owner of fixed interest security obtains for its sale, the market value, depends upon the current market interest rate. Let's assume that A bought a security from business Y in the last year and paid 1,000 euros for the right to be paid 50 euros annually for 10 years, and the original principal of 1,000 euros at the end of this 10-year period. Person A has thus purchased a bond with the nominal value of 1,000 euros and an interest rate of 5% relative to the principal. Now let's further assume that in the next year interest rates climb to 7%. That means that for any new bond costing 1,000 euros, the annual interest payment is 70 euros. If A now wants to sell his bonds, he won't find anyone who will pay him 1,000 euros for it, since the interest payment is fixed at 50 euros. Person A will only be able to sell the bond if he settles for an amount less than 1,000 euros, the market value of the bond falls below the nominal value when interest rates rise. In the case of falling interest rates, the market value would rise above the nominal value. Likewise, in the case of the sale of stocks, here the share prices are constantly changing, but their movement is not decided solely by the current dividends, but also by future profits of the business. Dividends play only a secondary role, since only a tiny portion of the profit is doled out to shareholders in the form of dividends. The greater portion is invested. However, the future profit is never a certainty, but rather an expected quantity. If the expectations of profit increase, then the share price can also increase. However, the future profit is never a certainty, but rather an expected quantity. If the expectations of profits increase, then the share prices also increase. If expectations decline, or if there is a great uncertainty concerning them, then the share prices decline. In this respect, the course of the share price does not express contemporary developments, but rather expectations concerning future developments. The circulation of securities and stocks constitutes an act of duplication similar to credit money. In the case of credit money, payment promises circulate alongside real money, whereas in the case of stocks and bonds, we are dealing on the one hand with real capital flowing from investors to a business and used by the business, and on the other hand, a claim on interest or the payment of dividends that is traded and circulated at fluctuating market prices. Due to their specific value determination, meaning the determination of market value outlined above, Marx refers to these circulating claims, securities, and stocks as fictitious capital. This term does not mean that these claims cannot be redeemed. Rather, it refers to the fact that the real capital the owner originally possessed in the form of money has been advanced only once, during the purchase of stocks and bonds. After that, it is possessed by the business and is advanced by the business. Securities, stocks, and bonds represent mere claims to certain payments. Their value, the market price, has nothing to do with the amount of value originally paid for these claims. Now this amount of value exists in the form of, for example, productive capital within an enterprise, or in the case of government bonds, has been spent by the state. The value of such claims is an arithmetic value, which in the case of fixed interest securities, rests upon the relation between the interest rate of the security and the current market rate of interest, and which in the case of stocks rests upon profit expectations. The extent to which this value is constant and leads to corresponding payouts in the long term depends upon the actual profits of their respective enterprise. Since profit expectations can change quickly, the course of stocks can also change quickly. For that reason, during a single trading day, billions of euros in market value, that is, billions in fictitious capital, are destroyed on the market in the case of rapidly declining share prices, and billions of euros in market value are created in the case of strongly increasing share prices. These amounts are not reserves that can be destroyed or newly created and hypothetically invested for other purposes, but rather are arithmetic valuations of commercial papers. However, these fluctuations are also not insignificant occurrences. If shares and bonds are used as collateral for loans, then the collateral is devalued in the case of declining market prices. The borrower then has to offer further collateral or pay back the loan. If he can't do that, he goes bankrupt. If the bank experiences too many such defaults, the bank is also threatened with bankruptcy. Expectations have a tendency to reinforce themselves over a period of time. If share prices rise, Many people want to hop on the bandwagon. The demand increases, share prices rise further, and even more money owners want to jump on the bandwagon. If share prices fall, then many people want to get rid of their stocks. The supply increases, share prices further decline, etc. Strong oscillations in performance are the consequence. A bull market, strongly rising share prices, is followed by a bear market, falling prices. Coffee break. Section 3. The credit system as a regulating instance of the capitalist economy. We can sum things up by referring to banks and capital markets as the credit system. The movement of interest-bearing capital mediated by this credit system is not a mere addition, a superstructure resting atop industrial capital. Although, as will be made clear shortly, interest-bearing capital emanates from the circulation of industrial capital, the movement of industrial capital is not at all possible without credit. In Chapter 3, we emphasize that Marx's value theory is a monetary theory of value. The commodity and value cannot exist, and also cannot be conceptualized without reference to money. The same can be said concerning the relationship between capital and credit. However, within traditional Marxism, a non-monetary theory of value is dominant, as was a conception of credit that reduced credit to a mere appendage that was unnecessary for the existence of capital and unnecessary for an understanding of capital. In the circulation of industrial capital, there emerges an array of funds that consist of temporarily idle capital. As a result of the sale of commodities, advanced capital returns that cannot be immediately employed as capital. Most important are accumulation funds, surplus value to be invested, but only at a later time because, for example, a minimum amount is required for investment, and sinking funds, in which the value elements of fixed capital are collected. Until they are invested, such funds can be used as interest-bearing capital. Instead of waiting for these funds to fill up, a portion of accumulation as well as the renewal of fixed capital can be financed through credit, so that the ensuing returns do not flow into an accumulation or sinking fund, but towards the payment of interest and principal on the loan. Ultimately, the circulation of surplus value, and that part of the total social product with a value corresponding to the total social surplus value, is not possible without either the existence of reserves or the issuing of loans. Disregarding fixed capital, the capitalist of a single country advanced capital with a value of constant capital and plus variable capital in the course of a year, but produce products of the value of constant capital plus variable capital plus surplus value. The question is thus posed as to where the money to pay for the products comprising the value of M should come from. I guess that's surplus value. You're throwing me off here, dude. One possibility consists in a part of the capitalist possessing a reserve fund in addition to the capital advanced for production. They could then purchase a portion of M, and the capitalists that have sold this portion can in turn use this money to purchase commodities from the first group of capitalists, so that at the end of the process, all of the products have been sold and the reserves returned to their original owners. However, a reserve fund existing only to facilitate circulation implies foregoing the chance to valorize this sum. If capitalists follows the maximum of the greatest possible valorization of capital, then they will not possess such a reserve, but will instead finance the corresponding purchases by means of short-term loans. It is thus the circulation of capital that generates temporarily idle capital on the one hand and the demand for credit on the other hand. The volume of credit increases with the growth of total social capital. The mere growth of credit transactions is itself not a sign of capitalist crisis or instability. A developed credit system makes it possible for an individual capital to forego the accumulation of reserves and lend out idle capital. But by taking out a loan, an individual capital has the possibility to accumulate far more than merely the profits of the previous period. Thus, for a capitalist enterprise, a certain amount of debt is in no way unhealthy or a sign of weakness. In pre-capitalist societies, producers usually went into debt only as a result of emergencies and more often had problems paying the interest on loans. Under capitalist relations, credit serves primarily to finance additional accumulation. Credit should raise the rate of profit as measured by the equity of a single capital. Let us assume the average rate of profit is 8% and the market rate of interest to be 5%. If a capitalist invests €1,000,000, he can only expect a profit of €80,000. If he borrows a further million, and this second million also yields the average profit, then our capitalist obtains an additional €80,000, from which he has to pay back €50,000 as interest to the lender of the second million. His total profit amounts to 80,000 plus 30,000, or €110,000. His own capital, the first million, has brought in as a result of the loan, not just the average profit of 8%, but 11%. This increase in the rate of profit is the primary motive for taking out loans. If expectations are not fulfilled, whether because an individual venture fails or while the general economic situation deteriorates, then it may come to pass that the actual rate of profit obtained lies below the official rate of interest. In this case, the borrowed capital has not yielded an additional profit but a loss, the difference between interest and profit. Further, the existence of credit also has effects upon the total social capital. The movement of capital between branches, through which the equalization of profit rates occurs, essentially consists of a change of credit flows, so that in one branch a lot is accumulated, while in other branches less is accumulated. The shift of already invested capital would otherwise be considerably more difficult and above all time-consuming. Credit and a developed credit system make it possible to concentrate and redirect enormous masses of capital in a short period of time. Often this is just what is required for the accelerated development of new forces of production, since the introduction of new technologies usually demands considerable initial investments. The existence of the credit system makes it possible, not just for individual capitals, but for the total social capital to accumulate more than just the profits of the previous period, insofar as the objective conditions of accumulation are in place. An expansion of lending can also lead to a considerable surge of accumulation, just as restrictive lending can choke off the accumulation process. To this extent, the credit system constitutes a structural regulating instance of the capitalist economy. Capitalists are anxious to invest as much capital as possible in spheres with the highest rate of where the highest rate of profit is expected, since these investments as a rule are at least partially financed through loans or the issue of shares. The extent to which the movement of capital goes smoothly and the speed of accumulation fundamentally depend upon the credit system, that is, the banks and capital markets. The credit system grants accumulation its flexibility. The credit system, quote, accelerates the material development of the productive forces and the creation of the world market, end quote. But the credit system is also the, quote, principal lever of overproduction and excessive speculation in commerce, end quote. Capital Volume 3, page 572. The regulation of accumulation by the credit system is a thoroughly crisis-prone process. The granting of credit, but above all the trade in stocks and bonds, live on expectations and insecurity. Speculation must occur, and this speculation can also fail and lead to the destruction of the invested capital. On the financial markets, this can lead to speculative bubbles, excessive share prices, and the subsequent crash, a sudden fall in prices. On the financial market, this can lead to speculations, bubbles, excessive share prices, and the subsequent crash, a sudden fall in prices. But before the crash, one never knows for sure whether it is a bubble or whether high share prices are indicative of an increase in the profitability of the respective capitals. It would be wrong to oppose speculative financial markets to a, quote, solid capitalist production. Every act of capitalist production contains a speculative element, since no capitalist can be completely sure he will realize his value or at what price he will realize his value. Speculation on financial markets is more obvious and rapid, but in no way something qualitatively different from capitalist production. Both proceed from necessarily uncertain expectations, and both attempt to achieve the same thing through the trade in their respective products, the maximization of profit. However, the relationship between financial markets and industrial production is not constant in either a quantitative or qualitative respect. This relation can be different in various countries and can also change in the course of capitalist development. Thus, discussions concerning the metamorphosis of the financial markets constitute one of the central threads of the debate in the past few years concerning globalization.